The stock of Lucid Motors has been trending in popularity recently, and a lot of people are wondering if they should buy more, sell what they have, or stand on the side and wait for a better timing. As the market is still very volatile at the moment, we should always be careful about which stocks to pick and what would be the exposure and their timing. Over the past few days, the price action of Lucid has brought the stock to around $17.81 before stabilizing around the current $19.60. Lucid has been on a very obvious sell-off phase recently, and the current sector-wide sentiment is also favoring this tendency as we speak. Honestly, if we look at the recent past and even the midterm past, Lucid has been ranging up and down with wide ranges, and I wouldn't say that there is a clear trend forming overall. Lucid's stock price performance has been greatly affected by the sector's performance and the capital's risk appetite. Right now, the overall sentiment is that most people prefer to have safety and yield. The EV sector, which provides you a promise that it'll grow significantly larger over the years to come, doesn't really satisfy any of those demands, and this is why it lost somewhat of its popularity over the past month and I would say even year. Despite the recent performance, I would argue that when the voices surrounding you are overwhelmingly favoring one scenario, this would be the moment that you should really begin considering whether the time is ripe to be looking for entry points, if you believe in the inherent value of the company. Now, let's also take a look at the technicals of Lucid. The trading volume of Lucid has recently been around 16 million shares versus the average of 22 million shares. Over the previous 52-week period, its price fluctuated between $16.12 and $57.75. The market cap of Lucid Motors is currently at $32 billion versus the enterprise value of $58 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on the current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If it has a lot of debts or a negative image, the asset's value may be impaired. And with that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's relatively less reactive than the market cap and often more lenient as well. One key element to note about the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company is able to generate more profit or to have more growth than another company, partially because it may have better management, a stronger brand recognition, and a bigger online following. It is what makes this company in particular unique compared to its rivals. In other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and because it's also less reactive than the market cap in very volatile situations. If the company goes to liquidation, the goodwill would be gone, and we would be left with potentially less assets to distribute to shareholders and debt holders than the number we currently see. When we compare the current price to the historical price fluctuations, the stock is 12% higher than the 1-month low, 12% higher than the 12-week low, and 22% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 98% versus a historical volatility of 64%. The put-call volume ratio is currently at 0.3. It's normal for many stocks to tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 16,000 contracts versus the 30-day average of 69,000. In terms of open interest, the most recent volume has been 1.1 million contracts versus the 30-day average of 990,000 contracts. In terms of its shareholder structure, institutional shareholders own 71% of the outstanding shares. The biggest shareholders include Vanguard, Invesco, and BlackRock. It's relevant to understand the shareholder composition of a company because it helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is that there should be around 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, there's a lot of exceptions to this because there are a lot of great companies mostly held by retail as well. But so far, that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this could be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 19% of the total float, and 58% of the transactions are coming out of the dark pool. Usually, if the short interest is above 15% of the total volume, and a lot of this coming out of the dark pools, or at least outside of the public exchanges, that could be a potential for a short squeeze. My plan for Lucid is to look for signs that the ongoing bearish tendency starts to show signs for reversal. Like, for example, if it refuses to go below a certain price level for more than 3 or 4 trading days, then I would consider this as a possible entry point. And I would also predict that Lucid may reach as low as $8 or $9 before rebouncing. That assumption is based on not only Lucid, but my experience with other growth stocks as well. And I will also keep in mind that the stock may just keep grinding lower until a major catalyst appears. But as far as Lucid is concerned, I believe that Lucid is solid enough for that scenario to not be the main one to consider. Overall, I could recommend keeping a position in Lucid as soon as you can see signs of potential reversal, and to hold the position for at least 6 to 12 months. I would recommend to commit between 1 to 3% of your capital in Lucid, maybe up to 5%, and split your allocation in batches of 20 to 30% at a time, so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.